welcome back to the second part of this topic. Now we are going to discuss the second learning objective here, which is to describe the accounting problems associated with the capitalizations of the borrowing cost. Okay. Now let's dive into the concept of self-constructed assets. The company often choose to build their own assets rather than purchasing them directly from suppliers. When a company constructs an asset on its own, the costs associated with the asset include two main categories: materials and direct labors, as well as the overhead cost. First, in the material and direct labors, these are straightforward. They include the raw materials used in the constructions and the wages paid to the workers involved in the process. The more complicated part should be in the overhead costs here. Overhead refers to indirect costs like factory rents, utilities, or equipment depreciations, which are not directly tied to the construction but still contribute to the overall process. And here, as you can see, companies have two options for handling these overhead costs when it comes to self-constructed asset. Option one is to assign no fixed overhead. And this method simply ignores allocating any portion of fixed overhead to the construction process. But it is not commonly used because it can understate the true cost of the asset. Point number two, which is more widely used, is to assign a portion of all overhead to the construction process. This method allocates a vast share of overhead costs to the asset, ensuring that the financial statement reflects the actual investment made in constructing the asset. So in practice, most companies adopt the second approach because it provides a more accurate reflections of the asset's costs on the balance sheet. This ensures that overhead costs are properly absorbed into the value of the assets being constructed. Now, let's talk about how interest costs are traded during the construction of self-constructed asset. If the company takes on debt to finance the constructions, interest costs comes into play. The diagram here shows that IFRS in the middle, as you can see here, requires a company to capitalize actual costs incurred during constructions, including interest associated with the construction. So it is in the middle, it's not in the left mainstream, which capitalize no interest during constructions. It is not also in the right mainstream here, which is capitalize all costs of funds. So IFRS requires to capitalize actual costs incurred during constructions. And this means the interest costs incurred during constructions are added to the cost of the asset rather than being treated as an expense. So any interest incurred from the financing of constructions is treated as the cost. It's not recorded as the interest expense. And this approach ensures that the cost of the asset reflects all necessary expenditures to bring it to its current conditions, which aligns with the principle of historical cost accounting. If we can still recall our concept of cost from our previous lecture, from our previous slide, then here is the applications of that concept. So when capitalizing interest, there are three main considerations to keep in mind. First, only certain assets qualify for interest capitalizations. Alright, so typically these are assets take a substantial period of time to get ready for their intended use. For example, here building or machinery, which is large machinery. And next, we need to determine the capitalization period, and this is the time during which the company is incurring expenditures and interest on the assets constructions. Interest capitalizations begins when construction starts and ends when the asset is substantially complete and ready for use. Finally, here, the third one, we calculate the amount to capitalize. And this involves determining the actual interest incurred during the period and applying a rate of interest to the expenditures made on the construction project. And we need to be aware here that only the portions of interest that relates to the constructions of the asset gets capitalized. By capitalizing interest, companies ensures that cost of assets reflects all necessary expenditures incurred during the construction process. Because here, the interest upon the amount we borrow from any party is used to finance the constructions of assets. So it according to the concept of cost, the interest paid by the company for this finance is recorded as asset. All right, so continuing our discussions on interest costs during constructions, let's focus on qualifying assets first. Okay, from this slide. Not all assets are eligible for interest capitalization, so it is essential to understand what types of assets that qualify. To be considered as a qualifying asset, the asset must require a substantial period of time to get ready for its intended use or sale. Or in other words, the asset needs to take significant time and effort to construct or to prepare before it's functional or available for sale. There are two main types of assets that qualify for interest capitalizations. Assets under constructions for a company use includes assets like factory, office buildings, or specialized machinery that the company is building for its internal operations. Since these assets take a long time to complete, the interest incurred during constructions can be capitalized. And this is the first one. And move on to the next one here, which is the asset intended for sale or lease that are constructed or produced as discrete project. Okay. The example for this is a real estate developer constructing a building to sell or lease out can capitalize the interest cost during the construction period. So whenever an asset requires a long preparation period and fits into one of these two categories, first and second here, the company is allowed to capitalize the interest incurred. This again ensures that all costs related to getting the assets ready for use or sales or rent out are reflected in the asset's final value. Now, let's take a closer look at the capitalization period. This is the time frame during which interest costs can be capitalized as part of the cost of the asset under constructions. The capitalization period begins when three conditions are met. Okay, you can see from 3 points here. This means the company is spending money on the constructions or acquisitions of the asset. Okay, so the first one here is expenditure for the asset are being incurred, and this refers to a situation when the company is spending money on the constructions or acquisitions of the asset. Example here is purchasing materials or paying for labor. Second one is activities for readying the asset for use or sale are in progress. This refers to any actions taken to prepare the asset for its intended use. Construction work must be actively taking place for this case, or significant steps must be underway to make the asset usable or saleable. And finally, interest must actually be accruing on the borrowed fund used to finance the asset. Without these conditions, there will be no interest to capitalize. The capitalization period ends when the asset is substantially complete and ready for use. At this point, no further interest cost can be added to the asset's value because it is ready to be deployed in operations or put up for sale. By clearly defining the beginning and end of the capitalization period, we ensure that only the interest related to the construction phase is capitalized, not for other use. Once the asset is ready for use, any additional interest becomes an expense, no longer part of the cost of the asset. Now, let's discuss on how to determine the amount of interest that should be capitalizing during the construction period. And it's going to be quite a long presentation. When a company incurs interest costs while building an asset, it doesn't simply capitalize all the interest. All right? Instead, there are specific guidelines to follow. Companies are required to capitalize the lesser of these two amounts: actual interest cost incurred and avoidable interest. So the company need to compare between these amounts and pick which one is a lower amount. Actual interest costs incurred, the first point here, refers to the total amount of interest the company actually paid during the construction period. It represents the real cost of borrowing to finance the constructions. The second point is avoidable interest. For the name itself, avoidable, the interest expense that can be avoided by the company if it had not made any expenditures for the assets. So basically, it calculates how much interest could have been saved or avoided by the company if there is no building of an asset in the first place. Okay, so it is actually the expenditures that can be avoided by the company if the company doesn't construct any asset, or in other words, if the company doesn't have to borrow money and incur interest expense. In practice, you can capitalize whichever amount is smaller. Like I said previously, we simply just compare this lesser amount of actual interest and affordable interest. We need to compare between those two. All right, so to give a clearer illustrations, we have an example here where we will calculate the amount of interest to be capitalized during the constructions of what we have here, specific purpose equipment. Okay, so we assume a company borrowed 200,000 from State Bank in January 1st, 2015, and the interest rate is 12%. The purpose of loan is to finance the constructions of special purpose equipment to be used for companies' operations. Construction began on January 1st, 2015, and the project completed by December 31st, 2015. So the constructions took 1 year to complete. Okay. During 2015, company made the following expenditure here to construct the project. So we have 4 expenditures during 2015 in January, April, November, and December. We need all figures here to calculate what we call weighted average expenditures later on. Besides these informations, we have we have other informations here on the existing debt of the company. So the company has 500,000 bonds payable with 14% interest, and 300,000 5-year notes payable at 10% interest. With these informations, we can calculate both the actual interest incurred and the available interest to determine how much interest should be capitalized during the construction period. So just bear in mind in your mind that we need all these informations to calculate the the interest that we need to capitalize. Okay, so let's walk through the steps needed to determine how much interest to capitalize during construction process by referring to our previous explanations, the 3 considerations from our previous slide. So in our example, the special purpose equipment here qualifies for interest capitalizations because it requires a substantial period of time to get ready, and it will be used in the company's operation. So it fulfills the first criteria of capitalization of interest. The next step is to identify the capitalization period, and from our example, the capitalization period begins in January 1st, 2015 and ends in 31st December 2015. By following these 2 steps, we ensure that only qualifying asset, which is the special purpose equipment in our example, are considered for interest capitalizations, and we also ensure that the period during which interest is capitalized is clearly defined, which is from January 1st, 2015 through 31st December 2015. In the step 3, we are going to compute the weighted average accumulated expenditures, and this step helps us in determining how much of the total expenditures can be considered for interest capitalization. And here is how to calculate the weighted average accumulated expenditures. We need to weight the expenditures based on how long during the year each expenditure was outstanding. The longer the expenditures was outstanding, the more time interest could accumulate on it. And here's the breakdown. On January 1st, 2015, 100,000 was spent, and it was outstanding for the full year, means 12 months. And because the construction process took 12 months, so the capitalization period for expenditure in January 1st here is 12 months. So it's 12 out of 12. So we just simply multiply 100,000 with 12 per 12. So we get weighted average accumulated expenditure for the 100,000. We get 100,000. Okay. On April 30, 150,000 spent, and since it was outstanding for 8 months, so we calculate for May, June, July, August, September, October, November, December, we get 8 months. So 8 out of 12 months. We take 8 per 12 of that amount, 150. It gives us 100,000 for the weighted average. Okay, we calculate the same for 300 and 100 here, and we have the total weighted average accumulated expenditure of 250,000. And in this step, we ensure that only the expenditures that were outstanding long enough to incur interest are included in the capitalization base. This way, we can accurately calculate the interest that should be capitalized. Okay, let's take the expenditure in the 31st December here. It's zero. What's so called? It's 0 per 12 because it's what the outstanding of 100,000 here. It's not long enough to be considered for capitalizations in terms of its interest. Okay. Next, on to step 4 for these calculations. We are going to figure out how to compute the actual and affordable interest that should be capitalized. Okay, you still remember our step 3, we need to compare between the actual and affordable interest, and here we are going to compute it in mathematical. We need to choose the right interest rates for different portions of the expenditures. So here's how we approach it. Depending on whether the company uses specific borrowings for the constructions or has other general debt, the interest rates we apply will differ. Okay, so first let's talk about the specific borrowings. It is number 1 here. If part of the money used to finance the constructions was borrowed specifically for this project, like from our example 200,000 loan, we apply interest rate on that loan. And this is quite straightforward. Use the actual rate from the loan meant for constructions. Okay. Now, if the construction costs go beyond what was borrowed specifically, so from our example, we borrow 200,000, and what if the construction cost goes beyond that 200,000? Then we will look at the company's other debt. Okay, so in the first point here, if the weighted average of the expenditure we obtained from the previous calculations, it's still up to the loan borrowed from other parties, then we will use the single interest rate for that specific borrowings. Okay. However, if the weighted average expenditure is greater than any debt incurred specifically to finance the constructions of the assets, we will use the weighted average of interest rates incurred on all other outstanding debt during the period. Okay, to get clear explanation on this, let's jump to our example. First, we need to see the actual interest. So the company has 2 categories of debt here. We have specific debt and we have general debt. The company borrowed this 200,000 at 12% interest rate specifically for the construction project. So this specific refers to this 200,000 is for the purpose of financing the project. Okay, so the actual interest on these specific borrowings comes to 24,000. In addition to the specific loan, the company has general debt here. We have, if I'm not mistaken, it is the bond payable and not payable. 500,000 bond at 14%, and 300,000 not payable at 10%. If I'm not mistakenly get from our example. To calculate the weighted average interest rate on this general debt, we first calculate the interest on each by simply multiplying the nominal, each nominal here with its respective interest rate. And so we get 70,000 for the bonds and 30,000 for the notes payable, and therefore it results in the total of the whole total here of 124,000 interest. And next, after that, we need to calculate the weighted average interest rate on general debt. What we are going to do here is the 100,000 here is coming from 70,000 plus 30,000 interest on the general debt is divided by the total general debt. Okay, means 800 coming from 500,000 plus 300,000, and we get 12.5%. So the weighted average interest rate on general debt we get here is 12.5%. Now let's move on to the affordable interest. So we have a weighted average accumulated expenditures of 250 from our from our calculations of weighted average accumulated expenditure, we get 250,000. Okay, and we will use that figure. Out of this 250, we take out the 200,000. What does it mean? 200,000 here is for the specific debt, for specific borrowings for the constructions, which we use the 12% interest rate for that specific rate, for that specific borrowings, giving us 24,000. And for the remaining 50,000, because we have 250,000 from our calculations, the remaining 50,000 we apply the weighted average from here of 12.5%, resulting in 6,250. So in total, the affordable interest comes to 30,250. Okay, I hope you can follow this explanation very carefully. In this example, the affordable interest is 30,250, and that's the amount we would capitalize because you can see from this slide the actual interest is 124,000, while the affordable interest is 30,250, because we need to take out the lesser between those two. So we have we pick this 30,250 as the amount that we are going to capitalize. Next step here, so we have step 5. We will determine how much interest to capitalize. Actually, we got it from our previous slide, and the rule here is simple. We capitalize the lesser of the affordable interest or the actual interest. Okay, and to record this in the company's book, we make the following entry. We debit the equipment account for 30,250. Of course, it will increase the value of the asset being constructed. And at the credit side, we put interest expense for the same amount, 30,250, and it will reduce the interest expense for the period by the amount capitalized. And this process ensures that only the necessary and relevant interest costs associated with the constructions of the asset are added to its value on the financial position, statement of financial positions. The rest of the interest, if any, remains as an expense on the income statement. All right, so quite a long explanation. I hope you can follow properly. And this ends our discussions on self-constructed asset. In the next sections, we will cover issues related to acquiring and valuing assets.